As missiles soar across the skies of the Middle East, the world is not only anxious about war, but also holds its breath over oil prices. The conflict between Israel and Iran, seemingly a familiar refrain, has erupted more violently than ever, especially with the U.S. no longer standing on the sidelines. But behind the gunfire lies another front no less heated: the global market. Is the world about to face a new economic shock? Amid persistent inflation, supply chains still unrecovered from the pandemic, and a prolonged war in Ukraine, the U.S. involvement in the Israel-Iran confrontation is no longer just a political issue. It's a spark for a global economic earthquake. The Israel-Iran conflict broke out on June 13th, beginning with an unprecedented series of Israeli airstrikes deep into Iranian territory. Tel Aviv stated that the reason behind these actions was to prevent a long-standing enemy from developing nuclear weapons, which they consider an existential threat to Israel's national security. Within less than 24 hours after the first strike, Israel continued attacking dozens of strategic targets across Iran. One notable target confirmed was Iran's domestic security headquarters in Tehran, a highly symbolic and tactical move showing the boldness of Israel's calculations. Tehran's response was swift and fierce. Iran launched a barrage of ballistic missiles and kamikaze drones into Israeli territory, stressing that its nuclear program is entirely civilian and peaceful in nature. A fierce tit-for-tat exchange of airstrikes continued for days, leading to rapidly mounting humanitarian consequences. According to the Middle East Red Cross, over 600 people were killed and nearly 5,000 injured within just the first 4 days of the conflict. More significantly, on June 21st, U.S. time, President Donald Trump appeared before the international media, declaring, "The United States, along with its allies, will act to protect the security of the Middle East." This message was immediately followed by action. The Pentagon deployed air forces, aircraft carriers, and special operations forces straight to the Gulf. Through the social media platform Truth Social, Trump confirmed that the U.S. had conducted highly successful airstrikes on Iran's nuclear facilities. The Israel-Iran war quickly plunged the entire Middle East into high alert, with the risk of escalation into a full-blown regional war becoming increasingly evident. With the United States, one of the world's leading military powers, officially entering the conflict, it has now surpassed the regional scope and evolved into a potential multilateral war with global implications. This event also marks a dangerous turning point. It is no longer a bilateral conflict between Israel and Iran, but a war that could entangle entire alliance systems and fracture the global geopolitical and financial order. So how much will the global economy have to pay for this ever-expanding war? First, there has been a strong chain reaction across global markets. Oil prices have surged, while investors are pulling money out of stocks in favor of safer assets like gold and government bonds. Starting with oil prices. As analyzed in our previous episode, about 1/3 of the world's seaborne oil passes daily through a narrow strait, Hormuz, right next to Iran. And in a war with Iran at its center, Hormuz becomes a vital choke point. Experts from the International Energy Institute warn, if Hormuz is blocked for just 1 week, global crude oil prices could jump by more than 40%. That means just a minor move from Iran, such as laying sea mines or threatening to fire on oil tankers, could send global markets into disarray. Once the US is involved, shipping routes will face severe disruptions. Shipments from the Middle East to Asia will be forced to take longer detours. Rising oil prices, rising transportation costs, rising global commodity prices. And the first to feel the impact might be consumers in Los Angeles, not Tel Aviv. Right after the US airstrikes, Brent crude surged from $91.8 to $124 per barrel, the sharpest increase since the Iraq crisis in 2003. US WTI oil exceeded $120 per barrel. As a result, gasoline prices in the US rose an average of 0.85 per gallon. Asian countries such as Japan, South Korea, and India, which import over 80% of their energy, are suffering from input cost shocks. The Global Consumer Price Index, CPI, could rise by 1.2 percentage points, according to IMF forecast. Next comes the stock market and global financial turbulence. On June 23, according to CNBC, the Dow Jones rose by 374.96 points to close at 42,581.78. The S&P 500 gained 0.96% to reach 6,025.17, while the Nasdaq increased by 0.94% and closed at 19,630.97. U.S. bond markets also saw major fluctuations. The 10-year Treasury yield jumped to 4.9% due to concerns over war expenses and budget deficits, while the U.S. dollar strengthened in the short term. Medium-term risks rose as the U.S. issued more public debt. The global supply chain has also been disrupted. Shipping giants like Maersk and MSC announced route changes to avoid the Persian Gulf. Container shipping costs from the Middle East to Europe have doubled. Air travel is also in chaos. Due to safety concerns, multiple countries, including Israel, Iran, Iraq, and Jordan, have closed their airspace. Major airlines such as El Al, Air France, Ryanair, and Wizz have had to cancel or reroute flights. Flight radar data shows that Middle Eastern airspace is virtually paralyzed, with traffic rerouted through Saudi Arabia and Egypt. The escalating conflict has severely impacted global aviation stocks. Political analyst Elijah Magnier in Brussels has warned that the escalation of the Israel-Iran conflict with direct U.S. involvement could lead to the closure of the Strait of Hormuz, causing severe global economic disruption.
Because Israel received the money from the United States, it has all the support from the military and the economy, and the United States is giving Israel enough weapons to continue the war. If the United States stop that, then Israel cannot wage war. It is indeed the most dangerous time for the Middle East, because in case of the participation of the United States directly, because it is participating indirectly, then Iran will close the Strait of Hormuz. Therefore, the world economy will be disturbed and will suffer delay. Everything will stop and people will panic. And then this is going to create a worldwide crisis, economic crisis.
In the near future, the global economic outlook is predicted to become increasingly bleak. Tensions between Israel and Iran are escalating amid global markets already affected by President Donald Trump's unpredictable tariff policies. The threat of high tariffs on imports into the U.S. has disrupted global trade, shaken investor confidence, increased costs for both consumers and businesses, and slowed global growth. If the Israel-Iran tension drags on, these pressures will worsen. Additionally, any disruption at major gas fields like Israel's Tamar or LNG exports from the Gulf will further strain energy markets in Europe and Asia. If the conflict spreads, maritime transportation and the tourism industry could be paralyzed. Since late 2023, Houthi forces have repeatedly attacked commercial ships in the Red Sea, a vital trade route, causing shipping costs to many major shipping companies have had to reroute around the Cape of Good Hope, extending routes and expenses. Though some research institutions have recently downplayed the risk of global recession, if Trump's unstable tariff policies combined with a prolonged Middle Eastern conflict, the risk of global economic recession could rise alarmingly. Thus, economies must prepare flexible response scenarios, from financial market regulation to securing energy and trade flows. In the U.S., within less than a week of declaring war, Congress approved an emergency defense spending package worth $96 billion. However, if the war drags on for more than 6 months, military spending could exceed $450 billion, about 2%. of GDP, a heavy burden on an already deeply indebted federal budget. As a result, the debt-to-GDP ratio could exceed 130%, a level unseen since World War II. This figure not only concerns Wall Street, but also raises the question, how will the US fund the war? It's not just the budget being stretched. American consumer confidence is also rapidly declining. The Consumer Confidence Index has dropped from 110 to 96, indicating public concern over prices, jobs, and future uncertainty. Inflation, which had just been brought under control last year, is showing signs of returning, pushing up living costs across fuel, food, and transport. And if the US becomes deeply involved in the conflict, rising war costs will place immense pressure on the federal budget. Given that the US already has over $34 trillion in public debt, war will require hundreds of billions more in borrowing. But with high interest rates to curb inflation, borrowing becomes extremely expensive. The likely consequences include U.S. government bonds losing appeal due to debt ceiling concerns, international financial institutions losing confidence in the U.S. as a safe haven, potential downgrade of the U.S. credit rating, as S&P did in 2011 after a debt ceiling crisis. The U.S. dollar, in particular, becomes a double-edged sword. In the short term, the dollar strengthens due to safe haven demand. But if the conflict drags on, the U.S. is forced to print more money, raising fears of oversupply and ballooning debt. The dollar loses relative strength, dragging emerging economies into currency depreciation and foreign debt spirals. As capital flows out of developing countries, regional financial crises intensify. Consequently, Europe may once again face the risk of an energy-starved winter, as oil and gas supplies from the Middle East are disrupted. This puts the European Central Bank in a dilemma: keep interest rates high to fight inflation or cut rates to support growth. Meanwhile, in Asia, major economies like China, South Korea, and India are rapidly boosting their strategic oil reserves, spiking global oil demand and pushing prices even higher. Simultaneously, many manufacturing firms must reconsider their spending and expansion plans due to rising input costs. As for Israel and Iran, surging military expenditures and the heavy damage caused by the conflict will impact both economies. Israel is in the midst of an expensive war, while Iran continues to suffer from years of economic sanctions. Israeli economist Yaakov Sheinin estimates that if the conflict spreads, the cost could exceed $120 billion, equivalent to 20% of the country's GDP. In Iran, a crisis-ridden economy already under sanctions due to its nuclear program. Oil exports are restricted, the rial is weakening, and inflation remains high at around 40%. Combined with direct impacts on infrastructure and consumption, the conflict has severely damaged regional market confidence. Investors fear prolonged war will lead to interest rate shocks, exchange rate volatility, and capital flight from risky assets. Throughout the above analysis, one reality becomes clear. The Israel-Iran conflict with direct U.S. involvement has triggered a wave of global economic shock. This conflict reveals a systemic truth. In the age of globalization, every military action sends aftershocks far beyond the battlefield. We are living in an era where the boundaries between war and economy are increasingly blurred. Today's war is not only fought in trenches, but also in trading floors, interest rate charts, oil reserves, and defense budgets. So where is the world headed? If the conflict continues or escalates into a broader multilateral war, the economic consequences may not stop at oil prices or inflation. It could erode market confidence, stall the global recovery cycle, and create deep, lasting cracks in an already fragile post-COVID economic order. The global economy is like a crystal vase, already cracked, and the Israel-Iran war with U.S. involvement is the next powerful blow. Without swift, coordinated policy responses and risk controls, what we're witnessing today may just be the beginning of a much longer period of instability. The war's end is unknown, but the economy, if not promptly protected, may be the first and clearest casualty of this increasingly unpredictable conflict.